Managing taxes on retirement income from multiple sources can feel overwhelming, especially when it comes to making sure you're optimizing your withdrawals and minimizing your tax burden. If you're a retiree with income coming from a mix of traditional IRAs, 401ks, Social Security, pensions, and possibly rental income or dividends, understanding how these sources impact your taxes is crucial for maintaining your financial security. Stick around because, by the end of this video, you'll have a clear understanding of how to manage these taxes effectively so you can keep more of your hard-earned money. Before we dive in, if you're serious about protecting your wealth in the next 2 weeks and learning why thousands of Americans are turning to gold IRAs to safeguard their savings, click the first link in the description. You'll get access to a free guide that could help you navigate some of these retirement tax challenges with a strategy that works. Now, let's talk about tax considerations when managing retirement income from multiple sources. First, it's important to understand how your withdrawals from IRAs and 401ks will be taxed. These are tax-deferred accounts, meaning that when you take money out, it's treated as ordinary income and taxed at your regular income tax rate. The more you withdraw, the higher your income, and the more you'll pay in taxes. So, it's crucial to plan your withdrawals carefully. One strategy retirees often use is to withdraw only what they need for their expenses, leaving the rest to grow. But even more important is understanding the required minimum distributions, or RMDs, that kick in once you hit age 73. If you don't take your RMDs, the IRS imposes hefty penalties, so it's critical to know when and how much you must withdraw. Now, let's talk about Social Security benefits. Depending on your total income, your Social Security may be taxable. If you're receiving Social Security benefits and your combined income exceeds certain thresholds, up to 85% of your benefits can be taxed. This means you'll want to keep an eye on the total income from all sources, as you could inadvertently push your Social Security benefits into the taxable category. Pensions can also complicate matters. While they provide steady income, pensions are typically taxed as ordinary income. If you're fortunate enough to have a pension, it's important to factor it into your total income when planning your taxes for the year. It's especially important if you're receiving multiple streams of income. One thing that can help is understanding your tax bracket and knowing how different types of income are taxed. For instance, dividends from investments, if qualified, may be taxed at a lower rate than your regular income. However, the key is to know how these different income streams interact with one another. Here's where gold IRAs come into play. By rolling over your existing retirement accounts like a 401k or IRA into a gold IRA, you can take advantage of tax-deferred growth and avoid the volatility of traditional stocks and bonds. Plus, a gold IRA offers you the added benefit of diversification, so your portfolio isn't reliant on the fluctuations of the stock market, which could lead to additional taxes during market downturns. With a gold IRA, you have a tangible asset that can potentially preserve and grow your wealth, and it's an excellent strategy for retirees who have over 100K in their IRA or 401k, or even 5MEM plus in savings. If you're nearing retirement or already there, and you want to learn how gold IRAs can give you a tax-advantageous way to manage your wealth, check out that free guide in the description below. Now, you might be wondering about rental income or other passive income streams. Rental income, for example, can be taxable, but you can potentially offset this with deductions for things like mortgage interest, repairs, and depreciation. The key is to keep accurate records and plan for these taxes as part of your overall tax strategy. Keep in mind, gold IRAs, as a more stable and tax-efficient option, may be a better long-term strategy compared to relying on the volatility of real estate or other assets. To summarize, managing taxes on retirement income from multiple sources means carefully planning your withdrawals from IRAs and 401ks, understanding when and how your Social Security might be taxed, considering the tax implications of pensions, and leveraging strategies like tax-advantaged gold IRAs to protect your wealth. If you're ready to take the next step and protect your wealth, especially if you have 100K or more in your IRA or 401k, or up to $5 million in savings, I highly encourage you to get that free gold IRA guide linked below. It could be the strategy you need to navigate retirement tax management and ensure you don't lose out on the wealth you've worked so hard to build. Thanks for watching, and I'll see you in the next video.